Hello there everyone, very interesting case today. I know I say that about all these tax cases that I bring you, but this one in particular is an interesting case, very fascinating. One of the reasons I think that is because I seriously think you can see both sides of the arguments. You can see exactly where HMRC were coming from in the court case. You can see exactly where the taxpayer was coming from in the court case, and you go, oh yeah, I can see that, and you go, oh yeah, I can see that. So what are we talking about? All right, we're talking about writing off overdrawn directors loan accounts. So as many of you know, if you have an overdrawn DLA, directors loan account, can be a problem if it's not repaid within 9 months of the company year end. If you're an individual or with a partner or family members, you've got your own SME business manufacturing your widgets, and you've got an overdrawn DLA at the year end, and if you don't clear it within 9 months, HMRC wants some tax. They want roughly a third of that, and then when you eventually pay back the loan, the overdrawn loan, they will refund you the tax thereon. So what you would choose to do is either physically repay it or say declare a dividend in the company accounts to clear your overdrawn director's loan account that way. I've done stacks of videos on overdrawn DLAs, go take a look. But in this particular case, it's all about, was the director's loan account actually written off? Because again, I've covered this. If, let's say, you cannot declare a dividend to clear your overdrawn DLA because you don't have enough distributable reserves, under company law, you have to have enough retained profits on the balance sheet, paper profits, to declare a dividend to clear the DLA. If you haven't got enough reserves, one of the things you can do is just to write off the director's loan account, write it off in the profit and loss account, not tax deductible for corporation tax, but nevertheless, on the flip side, on the director's tax return, it's treated as if it was a dividend for income tax. So the end game is the same as if you'd have declared a dividend to clear overdrawn DLA, you write it off, you still ended up paying income tax on that deemed dividend, not an actual dividend. So, just a quick overview of the rules. So in this case, Mr. X, he was into the company, his company, for the tune of about 450 grand. So his overdrawn DLA was pretty massive. Then the company went into trouble and it went pop, and they called in the liquidators, all right? And basically the liquidators did a deal with Mr. X, and they said, right, what have you got? Because the liquidator has to act on the benefit of the creditors of the company, all right? So this guy, Mr. X, ain't a creditor, he's a debtor. It's the other way, he owes the company. So the liquidator, even though they may have been appointed by him, I don't know, but they have to be seen to go after him and say, what, Mr. X, of your DLA, this massive chunk, can you repay? I'm not going to declare any dividends or anything like that. We want physical cash in from you to pay your creditors a dividend. That's one of a bad word, I'm getting confused with the dividends, but that's true. A dividend in liquidation, whether it be 20p in the pound, whatever it is, the liquidator's job, collect the cash, pay the creditors. All right? Mr. X says, look, guys, I can genuinely repay the company about 75 grand. Okay? And yes, I know I owe 450, but not only is the company in dire straits, there is no way I personally can repay 450 grand. I'll give you 75. And the liquidator said, yeah, okay, that's fine. So they'd done. So they'd looked at his finances. They'd said, all right, we'll take that amount. Thank you very much. It's part of the liquidation. I don't know if there was a dividend to the creditors or not, however many XP in the pound on what they received, but that's by the by. The point is this. The point is, on this guy's personal tax return, all right, on this guy's personal tax return, there was no income tax shown for the deemed write-off of this overdrawn director's loan account. So he owed 450 grand, he paid back 75, so he still owes 375,000, there or thereabouts. So he didn't just do assume that was a written off loan account and say, yes, on my tax return, I need to pay 45% of that as income tax. Didn't appear anywhere on his personal tax return. All right. So HMRC found out about all the linkage here and said, now hang on a minute. The liquidators, in this case, have written off that 375 grand that you still owe your company. They've written it off because, they've done a deal with you. You paid 75 on the 450. They've written off the DLA. You need to pay income tax as a deemed dividend on the write-off of that director's loan account. Thank you very much. Taxpayer said, no, there was no write-off. There was no write-off. The loan wasn't released. It was just the liquidators asked me for what I could afford and I paid them that, but there was no write-off. And this thing went to tribunal, and this is where you can see both sides of the argument really clearly. What is it? First of all, this is the tribunal, the actual law, because everything comes back to the tax law. And remember, tax law is written in the law. It's got a section number, section goodness knows what, from 1973 or whatever it is. And HMRC interpret the law and tax advisors interpret the law. And often they don't agree. Hence, you've got to end up in the tax tribunal. So the law in this case talks about releasing or writing off a director's loan account. I've said that the result of that means that there's got to be a deemed dividend, you pay income tax, and the tribunal tore apart. What does it mean to release and write off? Okay, that was one of the things that they looked at. They also had evidence from all parties, and the evidence from the liquidator was crucial, right? So the liquidator is not on anyone's side here. The liquidator is on the side of the creditors, but the creditors aren't in court here. It's the individual who used to run the company. So the liquidator is on his side. They are just giving evidence, right? And they're saying, here's the thing, is what they said. They said, we, liquidators, reserve the right to go after Mr. X in the future, should we become aware that he's come into money, and we will apply to the courts to reinstate the company that we're about to kill off. Okay? Hence, the liquidator is saying, technically, there's no write-off. There's no write-off of an overdrawn director's loan account because we reserve the rights. If circumstances change, remember, we're acting on behalf of the creditors. If we find out this guy's come into money in the next few years, we're going to go after him for that, to pay off the creditors that presumably have nowhere near been paid in full, and come after, and then and how you would do that, you'd reinstate the company. You'd go to company's house and you go through the company law and reinstate the company. So the liquidators, yes, 99 out of 100 times they put a company to bed formally, but in theory they can, once they've done it, apply to have it put back on for that reason, to go after the guy for extra cash. And because of that, they said, look, that's not a release of a loan account. And HMRC's like, are you kidding me? They're saying, what? They said, you did a deal back here. The guy owed 450 grand. You said, come on, give us 75 and we'll call it quits. And so you can see both sides of the argument. Surely, if ever there was a write-off of a DLA, it's there. The evidence is the liquidator saying, I'll settle for 75 because I know you can't afford 450. So then by default, the rest is just written off because we're not going to come after it. Okay. And HMRC said, look, it's obvious that's right. But again, this is powerful evidence from the liquidator, right? This is not the taxpayer saying, oh, the liquidator can come after. The liquidators themselves giving evidence. Well, on their filed notes, we reserve the right to reinstate the company. And that is what swung the tribunal's decision. So they fell on the side of the taxpayer. Mr. X, whose company went pop, he owed best part of $500,000 back to the company, could only afford to do 75, still leaving hundreds of thousands back to the company. That was not appeared on his tax return as a deemed dividend, and he did not declare an income tax. And when it was tested in the courts agreed. The fact that, in theory, it was never written off in the first place. You'd only pay tax on a deemed dividend if a DLA, an overdrawn DLA, is released or written off. So I thought that was a fascinating case there, because when I looked at this and I read it in full, looked at the arguments, I thought, yeah, you can see, I can totally. If I was the, the person acting on behalf of HMRC, I'd absolutely say, well, hang on a minute, surely it's cut and dry. You owed $450, they liquidated a deal on $75. That must be. The rest is written off. But no, if they, in theory, their course of action can continue, they can reinstate that written off, that liquidated company, put it back in the register, go after them again if circumstances change. So there you go. I thought that was a fascinating case on overdrawn directors' loan accounts. I guess the tip for the day is, if you have got an overdrawn DLA, do make sure you know what the tax implications are. I'm not necessarily saying you may end up going bust, but just generally in terms of that overdrawn DLA remains overdrawn within 9 months of the year end, and what you've got to do to get it repaid. If you like this video, please do subscribe, and as always, I'll see you soon.